Now, before I start, I have an appeal to make before you, which is please do subscribe to The Print. A lot of the ground reporting that we've come to be known for, what we've been receiving awards for, all of that requires considerable amount of resources, and it's through your contributions that we can make this possible and bring you news from across the country that nobody else is really reporting. But apart from that, it also brings you a lot of advantages. One, if you subscribe, you get access to an ad light version of The Print. Two, it gives you access to Ask Me Anything sessions with our editors and our reporters, where you can ask them any questions and they'll answer them live. And three, it gives you access to newsletters that are written by our editors and that come straight to your mailboxes on the news of the day and what they think about them. So please do subscribe. The link is in the description of this video. Hello and welcome to The Print. I'm TCA Sharad Raghavan, Deputy Editor, and I'm going to be speaking to you about how the RBI's high repo rate, which was meant to lower the amount of credit people and companies take and thereby lower inflation, has failed in its one job. Growth in personal loans has finally come down, but that's due to different reasons, as I'll talk to you about. In its latest meeting earlier this month, the RBI's Monetary Policy Committee kept the benchmark repo rate unchanged for the 11th time at 6.5%, despite calls for rate cuts by ministers in the Modi government. The RBI governor at the time, Shaktikanta Das, argued that high inflation remained a concern. The repo rate is basically the rate at which the RBI lends to commercial banks and therefore has an impact on the rate at which these banks lend to their customers, both companies and individuals. Higher the repo rate, higher the lending rate, and theoretically, the lower the credit offtake from these banks as loans become more expensive. This lower credit offtake is meant to reduce the supply of money in the economy, thereby lowering inflation. One criticism of this policy has been that inflation in India has been driven by high food prices over the past year and a half or so, something the repo rate cannot control. Now, the analysis by The Print shows that the repo rate has failed to control even the factor that it can directly impact, which is credit offtake. The data shows that the high and unchanged repo rate had a very short-lived impact on the borrowings of households and companies, with growth in credit to both these categories rebounding quickly. What finally did curb growth in personal loans was not the high repo rate, but the RBI's other steps to hit the brakes on unsecured loans. These findings are significant in the run-up to the February meeting of the MPC, which will be the first under the new governor, Sanjay Malhotra. This is when they'll decide next on whether to cut the repo rate or not. The MPC increased the repo rate in stages from 4% in April 2022 to 6.5% by Feb 2023 in an attempt to control rising inflation. This series of rate hikes was accompanied by a sharp slowdown in credit growth. The growth in personal loans, for instance, slowed from a staggering nearly 28% in October 2022 to a little more than 19% by May 2023. Growth in loans to industry slowed from 15% or so in October 2022 to just about 5% in March 2023. This effect was, however, quite short-lived. What followed was surging growth in personal loans driven by unsecured loans and accelerating growth in loans to industry. Even though the repo rate had been a high 6.5% for 5 months by July 2023, the growth in personal loans jumped to nearly 32% and remained above 30% till June 2024, nearly a year later. Similarly, growth in loans to industry steadily accelerated to 11.3% by December 2023 and remained hovering about the 10% mark until October of this year, despite the repo rate being high and unchanged for 16 months by that time. The reason for this strong growth in credit was likely driven by two reasons, according to economists. The first was that this period also saw strong economic growth, creating an income effect. This effect happens when strong economic growth creates the perception that demand will also grow strongly, and so companies take loans to expand and meet this demand. The second factor at play, according to the economists, could have been that stubbornly high inflation, which the high repo rate was supposed to bring down, was actually pushing households to borrow more to meet their expenses. Retail inflation during 2022-23 averaged a very high 6.7%, higher than the RBI's upper bound of 6%. In this financial year, the expectation is that inflation will average 4.7 to 5%, also higher than the RBI's target of 4%. From May 2024 onwards, something interesting happened. The growth in personal loans started dipping sharply. From 32% in May 2024, the growth in loans to this category slowed to just 13% by October of this year, the lowest it has been for more than 2.5 years. Personal loans account for about 1/3 of all credit given out by banks and NBFCs. And so this slowdown meant that the growth in overall credit offtake also slowed sharply, from 21% in May 2024 to 12% by October. But was this because of the sustained high repo rate or due to some other factors? Spoiler alert, it was not the repo rate. In response to the 30% plus growth rate in personal loans, the RBI in November 2023 took other steps to clamp down on unsecured loans. The central bank issued a notification increasing the risk weight of consumer credit and credit card loans given out by banks and NBFCs. The move required lenders to keep aside a higher amount of capital to back consumer loans, which basically made them more expensive for banks to give out and correspondingly more expensive for borrowers. According to economists, the impact of this trickled down the system and started having an effect in May or June 2024, as can be seen from the graph. Basically, the data and the economists both point to the fact that the RBI's policy so far of keeping the repo rate high and unchanged has failed to have the desired outcome. That is, it didn't discourage people from taking loans. That discouragement came from other decisions. This is perhaps something the new RBI governor should keep in mind during the next MPC meeting. But on that note, that's all from me. Thank you for watching.